Hello everyone and welcome to Investment News TV. My name is James Burton and I'm here at Schwab Impact 2025 in Denver. Delighted to be joined by Chris Hedges of MFS, head of RIA Bank Trust. Chris, thanks for joining us.
James, good to see you.
Just on the general theme of talking to advisors, what trends are you noticing? What are they looking for right now?
I think they're looking for solutions that help their clients with long-term goals, but they're also looking for solutions that are dynamic and the solutions they understand. So you've seen a lot of movement into ETFs from funds. You've seen a lot more customization around SMAs, custom indexing. That's all well and good as long as it drives a client benefit that they understand and can explain. If it sounds good but doesn't work good, if you will, then it was really all for nothing, because a lot of the portfolio building blocks that MFS and companies like us produce have decades of proven returns and of generating the results to get clients to retirement, to get clients to be able to pay for college. That's still very true, and I think advisors are looking to sift through the noise and find solutions that are modern, that work, and are efficient for their clients.
In terms of asset allocation, and we talked about internationals exposure there.
Yeah.
Again, what are you seeing? Where are people wanting to move their money? Are you seeing any patterns in that?
We're seeing a lot more advisory firms. They've been boosting their international exposure. Many of them were underweight to zero weight in recent years, and that worked for them. But then you started to see more of a compelling case in international markets. So they're going back to their good friends that have good products in this space and either upping their allocations or, putting that back into the portfolio. And, international for many years has been kind of a portfolio performance disappointment. But this year it's worked. And I think it's proven again why, if you're patient and if you look at these long dated investing projects, retirement, your 529, legacy, you're not worried about 1 year. You need to be worried about what happens over decades. And that should be a full market cycle, ups, downs, real bear markets. Having these components all together, it does work. In the near term, you can get frustrated. Good to see international performing well again.
So they're sticking on international because I think it's interesting.
Yeah.
I mean, where's hot right now? You got the globe, you look at a map of the world.
Yeah.
Where are you seeing positive returns? Where are you seeing good stories?
So we aren't as much of a macro shop. So if you see a Japan overweight in an MFS portfolio, it usually has to do with us finding a lot of good companies in Japan. So we're a fundamental research shop at our core. So an overweight in a region is usually because we have found a lot of companies in a country or in a region, Europe, that have strong prospects. So that's what would drive an overweight from an MFS perspective. So Japan is one place that's been good. We found a lot of opportunities in Europe, and we continue to feel that those opportunities will produce results.
Talking about that, this is a good segue into active management.
Sure.
Picking companies, like you said, fundamentals. I'm going to play devil's advocate a little bit with my next question.
Sure.
If, argument's sake, we expect a bit more volatility maybe in the market, why should I go active management? What is the argument against sticking in a set and forget it fund?
So down markets tend to favor active managers because they can play a little bit more defense than a benchmark, and they can do it quickly. So we can start to underweight, reduce exposure to overexposures in a benchmark, and we can do that more quickly. We can also tilt the portfolio a little bit into, maybe if it's a growth portfolio, move from momentum to GARP a little bit more quickly. The benchmarks reconstitute on a schedule, and when they get overly concentrated, it takes a long time before they can work that concentration down, or the concentration works itself down through market depreciation from some of the major constituents. We're not constrained that way. We can make these moves today.
Fantastic. Chris,
Yeah.
Thanks for your time.
Thanks,
Appreciate
James.
it. Enjoy
Lots
the rest
of
of
fun.
Impact.
You too.
And we'll see you next time at Investment News TV.